understanding what your core differentiation is, which then will drive your business model design. It'll drive your margin. It'll drive your capability to have pricing power, right? It'll drive what type of value proposition you can offer to your customer. I think it's really the key part of it.
Welcome to the Strategy at Scale podcast, brought to you by Scaling Up, Outthinker, and the Growth Institute. I'm your host, Kaihan Krippendorf. Our mission is to cut through a sea of contradictory business advice and get to what actually works. We interview entrepreneurs and business builders who've successfully scaled companies across industries to extract proven, high-impact strategies for building long-term value. You just heard from Tushar Amin, a seasoned strategy executive and operator with a track record of building businesses inside some of the most complex corporate environments. Now, usually on this show, and generally when people talk about scaling businesses, we think of entrepreneurs, people who build a business from scratch. But an equally important application of the strategic tips we cover here is this: how can you scale a business from inside an existing business? And that brings us to Tushar. He's done this more than once, including building a $2 billion business inside IBM, which is the focus of our discussion with him here. He was deep inside a legacy business unit at IBM, what some would call a classic cash cow, flat top line, big margins, the kind of place where you're supposed to keep the wheels turning, not reinvent the engine. But what he saw wasn't a business in decline. He saw an underutilized global asset, a supply chain built for a different era that could be reframed into a competitive advantage. Over the next few years, Tushar helped scale a completely new, fast-growing $2 billion global service business inside IBM. Not by throwing out the old model, but by building a new one on top of it and asking the right questions, like, where are the profit pools in the ecosystem? What do we really have that competitors can't replicate? And how do we reframe internal assets as external opportunity? This is an entrepreneurial story. It's also a strategy story. And most of all, it's a story about how to see clearly, to see where the value really is, even if no one else sees it yet. In this episode, we cover how Tushar found a Horizon 2 growth opportunity buried inside a Horizon 1 business and built it to scale. Why identifying profit pools in your ecosystem is more powerful than just sizing the market. The framework he used to align go-to-market, offering, and delivery, and how it helped him scale fast. What it takes to convince a large organization to bet on long-term growth, even when it threatens short-term margins. And how a clear, credible value proposition rooted in real differentiation became the key to pricing power and growth. Whether you're inside a legacy company or building your own, this conversation is packed with the kind of strategy and execution wisdom that helps you grow smart. Let's dive in with Tushar Amin. Tushar, thank you so much for taking the time to sit down with us. I know, as I already explained to our audience, your experience in finding, scaling strategies and businesses is you really bring a very unique perspective and such experience. So I'm excited to dive in. I know we won't have time to go through everything, but just want to thank you for being here with us.
No, great. No, thank you, Kai, and thanks for having me. Really looking forward to share a little discussion around some of these experiences.
And, what I particularly appreciate about your experience is that you've been both on the strategy and the execution side, because when those two are detached, then kind of one is, what is it, that phrase, vision without action is a daydream, but action without vision is a nightmare. You need both. And so to have someone who actually comes up with the idea and actually makes it happen is great. So maybe just give us a little bit. I've already given people background a little bit on your career arc, but maybe just walk us through one example of a scaling project or business that you've built, just to kind of bring us into your world.
Yeah, sure. During my tenure in IBM's Global Technology Services unit, which was, about a third of the company at the time, we had a series of businesses within that unit, as you'd imagine, right? One of those businesses was around providing maintenance and support services for basically the IT hardware products that IBM built and sold. So this was what you would call a cash cow type of business. very kind of flat in terms of top line, highly profitable, etc. We basically built within that business a $2 billion plus business around support services for third-party technologies outside of IBM. And we built it with a very attractive margin profile and, got it off the ground. And I'd say from 0 to 3 years, it went from 0 to $3 billion.
Wow. Yeah. So you have other examples, but maybe we kind of pick that as the example that we turn back to. And I was going to kind of dig into your head a little bit. Like first, it seems from our, just logically and from the interviews, it starts with the realization that there is an opportunity. And so you must have seen that there is an opportunity to offer these services to non-IBM providers or non-IBM manufacturers or non-IBM hardware. What was it that indicated to you that this was an opportunity?
I'd like to say we looked out into the market and saw the opportunity and proceeded, but it didn't really work that way. We were actually troubleshooting the business. At the core of the business was a large fixed cost supply chain asset. So think about this. This was an asset originally built in the company for the IBM typewriters. It is a supply chain asset with distribution centers, trading licenses across 150 countries, parts lockers, support centers, etc. So a very kind of vast global supply chain asset. With the volumes of IBM hardware coming down over time, the business was kind of facing a deflationary top line, and we were managing it as a cash cow. However, when you looked at that supply chain asset, we had small instances of where we were doing a little bit of offloading work for other businesses, right? And really, we thought of this whole set of support services we do as an extension of hardware IT manufacturing business. It's only when we started to think about it as its own business, as a set of services with set of capabilities, and really seeing that there was some differentiating asset that we had under the covers, did we really go and do a different type of market analysis. When we started looking at it as a business, we went out and looked at the market, and you would think we did a traditional analysis of the market. What you look at in terms of market size, including TAM, the buying behavior in this market, the trends that are going on at the time, cloud computing really, driving individual hardware sales down, therefore support sales down, centralizing the purchase of any support needed. And we looked at all those things, and as well, we looked at the buying behavior of the
what was it about the buying behavior that you noticed?
Well, it was moving in that market, which we didn't participate in, other, third-party technology support services. It was moving to more centralized buying because, the IT products were moving to more centralized data centers, big cloud providers, etc.
Okay, so just to visualize it, I'm picturing before we shift towards services as a software as a service, you might have individual offices spread out throughout a country, making different buying decisions. But now these decisions become more centralized with centralized.
That's right. And there's two parts to it. There's the people who actually make those IT equipment, and then there's the people who actually buy them. Both have needs for this type of service, right? So when you buy a piece of IT hardware, there may be a maintenance period, a warranty period that starts with it, where you get these services from the manufacturer. But then eventually that runs out, and you move on to extended support services, et cetera, et cetera. So yeah, that you pay for. So when we looked at the market, one of the things that we found pretty effective when we look at new businesses and new markets is you not only look at the total market opportunity, the TAM, if you would, segment by segment, subsegment by subsegment, but you also have to look at what we used to call profit pools. So what's the ability not only to get the top line out of those market segments, but what's the ability to actually construct a business model that's capable of capturing the opportunity and enough value or margin within that opportunity to be.
So I mean, I think the concept of profit pools is really fascinating. But just so that everyone understands what we're talking about, the metaphor, as I understand it, is we could kind of imagine a chain of an industry or part of an industry, from making the parts to assembling the parts to storing it to warehousing it to selling it to servicing it, and along that chain, profit may pool, might collect, like, and where that profit pools along the chain may shift. And so you're looking at where is the margin, so to speak.
Exactly right. Where's the margin or the value, just to put a generic word on it? Where is the value distributed in the ecosystem, right? How much is in the supplier? How much is, in various other players in the whole ecosystem, right? And what we found when we looked inside of these market segments of largely what was a highly fragmented market of third-party service providers in the support area, what we found is that those players weren't extracting a lot of the profit pools. It was trapped more in the supply chain. So with the ability of having this supply chain asset, we were able to go after the market in a way that, with a business model, in a way that let us capture value more so than those third-party suppliers could do, because we could reach into the supply chain and capture a lot of that value too with this unique asset that we had. And what that allowed us to do was, ultimately, if you can construct the right business model to go after that, it gives you pricing power at the end of the day. Or it gives you pricing power, or it gives you margin. Because I think at the end of the day, the pricing power comes from your ability to have margin, right? And you get that through differentiation. You could get that through where you focus your go-to-market in terms of profit pools, but you can also get that in terms of your core differentiating. I think 9 out of 10 times that's where it mostly comes from. You may get lucky, but
So we try to visualize this in an oversimplified way. I'm buying some equipment, and at the end of the day, I want this equipment and I want it working. And the money that I pay, the manufacturer gets some of it, the supply chain gets some of it, the maintenance support gets some of it. And what you're saying is that you saw that there was a meaningful amount of that profit was getting captured by the supply chain and the maintenance. And so you realized that there must be an advantage there, and you had an asset that could provide that.
Yeah, essentially that's right. The one thing I'll add is that the other players in the market were the manufacturers themselves, right? And their ability to set up a supply chain capability that, allowed them to do these services at a reasonable cost level to them, and therefore a reasonable price that they could pass on to their customers. We kind of believed we had a advantage over those other IT hardware manufacturers.
Because you had already built a lot of this. You had
it was a fixed cost,
yeah, some cost, right? So your marginal cost was very minimal compared to them building it from scratch. The replacement cost of what you had built would be high.
Yeah, the marginal economics on it were good, but they weren't as good as you would think, because when you go to maintain another technology provider's technology, you need a certain level of their IP. And if it wasn't your own IP, you had to go acquire that IP. So, so there was a marginal cost for a third party to do third party support services that wasn't just the cost of the incremental unit of adding an additional customer technology or demand unit onto that supply chain.
Okay, yeah. So it's not zero marginal cost, but it's but there's advantage.
Yeah, and it varied to depending on the type of technology you were providing. And at the end of the day, what that meant was, if you remember, this was kind of H1 business.
H1 meaning Horizon 1, from the Horizon 1, Horizon 2, Horizon 3 framework. Yeah.
And cash cow, H1 business, whatever you want to call it. I've always been a fan of the Horizon framework, although I think the lesson that I learned in going about this particular initiative was that, you can't apply it. You can't apply it blindly, because what we did at the end of the day is we found a Horizon 2 business inside of a Horizon 1 business. And, Horizon 2 businesses require investment, et cetera. And the tough part about it was the margins were good from a service perspective on the new business we were developing. However, they weren't as good as the core cash cow service margins. So, left onto the, standard kind of logical management systems that most large corporations employ, including IBM, it wouldn't have been allowed to grow up and nurture inside of that construct. So we did have to break a lot of glass in terms of raising it up to a level in the company that allowed us to justify that, while the margins and the cash flow may be potentially dilutive to this cash cow unit, they are accretive to the company as a whole. So it's the right thing to pursue. So, a lot of the operational things that followed, we had to make adjustments.
So like an analogy for, say, an entrepreneur would be your investors are backing you to just be Horizon 1 cash cow. And now you're saying, look, there's a growth opportunity here, but it's going to diminish our margins and in the near term, but it's going to have a longer term potential. And we have to convince the investors to say, yeah, we'll let you do that, even though we have you categorized as a cash cow.
Right. And what I really meant by that is if you're managing a cash cow, you're typically looking at the margins. The justification of this type of business in the longer term is certainly you have to look at it as, is it going to be accretive or dilutive to your margins? But there's also, is it going to be accretive or dilutive to growth? And is it going to be accretive and dilutive to cash flow at the end of the day? So, those things that a company's inherently valued upon are gonna have a major decision criteria into do you invest to do this or do you not invest to do this?
Which goes back to, when we were setting this up, that fourth question is, what do you invest in, not invest in, right? So there you got a revenue drive, revenue primary, cash flow, margin primary, or cash flow. Interesting. Okay.
And I think those are things a large company would also look at. I think, if you were, going back to your analogy, if you were an investor looking at a business and backing a business, you would look at those things. But I think those are things typically a large company would look at. And consistent with a lot of your thinking on entrepreneurship, these are the constructs that kind of need to get broken when you're really looking to scale a business. And I'm not talking about generate small growth here or there. I'm talking about, can you take something from concept to billions of dollars, and can you do it quickly because you have some sort of differentiating capability that allows you to?
And what were your differentiating capabilities in addition to the sunk cost that gives you that marginal cost advantage? Were there additional advantages that you felt that you had?
Yeah, I think this business, both the high growth business we generated and the base, stable cash cow business, were part of a larger services business. In that larger services business, the majority of that business was IT outsourcing, large customer sets. So one of the advantages we had was we had a very extensive customer base and customer supplier relationship base. So we had portions of the go-to-market that were already connected to the major IT suppliers, as well as customers who owned equipment. And I think that allowed us to really put into place the right go-to-market inside of this business, which we did set up a separate go-to-market because, when looking at how to construct the go-to-market, you have to be very attuned around two things, I think. One is how the segmentation of that TAM breaks down with the buyer behavior, et cetera. How are they going to buy? What is the opportunity out there? How are they going to buy? What will be the average transaction size? And do you have a handle on the unit economics to the right degree so you can put into place that go-to-market. And what we found in this business was the most compelling growth came from doing this service for the manufacturers of IT hardware and software, right? And in doing that, our go-to-market was set up as very similar to the way our go-to-market in the other services business were set up. Large deal-making contracts, multi-year sign-on, face-to-face.
Why did you decide, or what were the alternatives in that decision? Maybe it was just given, and that's just the way the market worked, but having the manufacturer pay versus the buyer pay, like who pays? Did you debate that?
It was less of a debate because the services were kind of segmented towards the individual customers. So there was a set of services for manufacturers, and there was a set of services for owners. There was a set of services for third-party suppliers as well. We could be the OEM engine under the cover, right? I think the menu, like I mentioned before, the one that seemed to take off most was the IT hardware manufacturers. Later on, we added software to the mix, supporting software of other software suppliers, providing software support, as well as providing software support for open source software. And those kind of services were more geared towards customers.
I'm just asking because this is a naive question, but I'm guessing that if one of the advantages is your existing customer base, because you already have relationships, I would think that you don't have relationships with manufacturers because they're more competitors, but you have relationships with customers. But I'm just might be kind of oversimplifying.
Yeah, you would. I think you would think that on the surface. However, the relationships we had with customers were around outsourcing their entire IT infrastructure environments, and it's outsourcing the services around that IT infrastructure environment. So operating all of the data centers of a large bank, for example, or a large retailer, right? And when you look across the IT floor of those retailers or large banks, it's not just IBM equipment. It is all sorts of manufacturers, Cisco network gear, Oracle databases, HP gear, all of that existed. So, by very nature of having that business, we had relationships with those manufacturers.
You see profit pools, you see a Horizon 2 opportunity that says there's an opportunity here. And then you say, can we compete here? Do we have an advantage? Yes, we do, because we have existing customer base and we have this installed sunk cost assets capabilities, right? So that says, yes, there's an opportunity and we could uniquely pursue the opportunity. Am I simplifying too much?
That's right. No, that's the essence of it. That is the essence of it. I wish it was that clear when we were going through it. However, that was the essence of it. And we got there. And like I said, it started with a problem solving where we looked at, hey, we had do we have an opportunity gap in this cash cow business? And the answer ended up being, yes, we do. And then we pursued.
Great. Then talk to me about the pursuit of it, because it seems that there's probably a lot of like operational and organizational, like you have to get a team, you've got to build, I don't know, a sales organization, and tell me about what that challenge was like.
Well, the advantage of doing this at the strategy level is it's done hand in hand with the P&L owners of the business. So we had a remarkably open general manager to this business that was also trying to solve the problem of erosion in the business to begin with, right? So as we went through step by step, it wasn't a satellite strategy team doing this. It was hand in hand with the general management of the business, taken up to the top levels of the business on the regular checkpoints that happen with the top levels of the business. So we had strategy review sessions, we had regular quarterly financial reviews, etc. We built the business case. We got the buy-in from the top level. It required us, because we had to use different parameters of financial management in the company. It required us to convince the CFO. And I think given the CFO's role and knowledge of, across the business around how value is generated for the business, it was a pretty straightforward thing to convince the CFO. It was a much harder thing to operate in the beginning inside the existing management system, where there's a lot of room between the top of the company and the people executing the business. So we did have challenges in terms of metrics and management. We're growing a business that's dilutive from a margin perspective to a cash cow business, and we're sitting within that business. So the top line dynamics of that business start to look really funky, right? We set a plan for flat growth. Now you're growing revenue, but you're deteriorating margin. Those types of discussions in the regular management system can often cause delays in investment, delays in hiring to fulfill growth needs, etc. So it was very important that this be a very kind of strategic level initiative at the business level, taken through the company. And actually it was made, less of an external view, but it was made more as an internal growth initiative at the top line of the company. So when the top management across the company would meet quarterly with the CEO, this was always highlighted as one of the business initiatives that the company was taking to, better position itself in the future, better position growth, all the benefits that it delivered across IBM.
Yeah, I was going to ask you, so how did you frame the opportunity to be able to overcome? Because again, I'm simplifying here. And I'm kind of like also linking it to, say, an independent entrepreneur, just to go between them, right? So I got this business. The rest of the organization is saying, hey, we don't want revenue growth. We want margin. Now you're giving me revenue growth, but it's lower margins. And so to overcome that, what you're saying is, no, that the objective here isn't the objective of the unit. It's the objective of the overall company to position us for future strategic opportunities, or it matches a strategic objective of the company, if not the business unit. Is that conversation?
Yeah. I think at the core, it was you have to position it around the strategic objectives of the company as a whole, like you said. And if you looked at the time, the strategic objectives of the company included growing services businesses related to the most recent technology trends like cloud, et cetera. So I think we were able to effectively latch on in terms of that type of, CEO mandate.
So going back to the three horizons, am I right in saying that you're saying, look, this is not a Horizon 1. This is not only a Horizon 1. This sits within a Horizon Run business, but this is Horizon 2 business, and it is a Horizon 3 business because cloud is going to become really big, and this gives us the opportunity to play there.
I wouldn't characterize it purely as I would characterize it less as a Horizon 3 business and more as a Horizon 2 business. I think, at a similar time, we were also launching another, $1 billion growth initiative and unit around cloud. And that was more of what I'd call a Horizon 3 business, a lot of upfront CapEx, the financials and the margins to return over a period of time built into a business case, et cetera. So that to me was more of the Horizon 3 type of business. This business, because it was a services business at its core, was able to, with some seed investment, was able to go along and fund itself. Services businesses have a very nice cash flow profile. They tend to be really, really scalable in terms of growth. You don't need a ton of investments once you got it started and once you've got it up and running, outside of core IP assets you needed in this particular initiative. So I definitely would put this in the Horizon 2 category. But going back to my earlier statement, I think, I said I really like the Horizon framework in terms of managing portfolio businesses, but you can't be overly wed to it, because if we had just managed our Horizon 1 business as a Horizon 1 business, we never would have gotten this growth. And and it takes a lot to kind of break your management systems and get something in place. But the flywheel effect, once we got through the barriers of investment and got people to see through the right metrics and performance reporting, that this was a business that actually added value to the company as a whole, pursued our strategic initiatives and revitalized a cash cow.
All right, and I want you to get a little bit more on this alignment. So I hear the metrics, performance reporting, leadership support were things that had to be aligned. A double question: was the idea that this business would eventually detach from and be operated independently of the core? And if so, to some extent, what were the other alignments that you had to do? Did you have to build new capabilities or new units or hire different types of people or change processes or change systems? Were there other things that you had to change to be able to build the organization to give this business its best chance for success?
Yeah, no, that's a great question. We definitely had to, even before thinking about the business separate, we had to change systems and processes, et cetera. The organization, the reorganization we had to do to make this happen was, however, mostly around the go-to-market. The 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 that core asset that created all the benefit for us to launch off of and create the attractive marginal economics from, that is something that couldn't be separated. So it was part and parcel of not only that core support services business, but also the IBM hardware manufacturing business. So at the end of the day, it was very difficult to think of this as a separate business with the same economics split away from the Horizon One business. And therefore, what we did was we set it up as almost like a side-by-side business, but it shared common delivery. While the go-to-markets were separate and the customer management was separate, the core production capability, the core differentiator asset in this case was in no way.
Got it. Is there in your mind, it might be an existing model or it might be just in your head, you have a model that would help someone think that through? Kind of what I'm picturing is kind of a box at the bottom. There's a platform, which is the production. And then above that, you've got the go-to-market, marketing, sales, customer support. And you have like two different boxes going to two different customers, or how do you try to get in your head a little bit?
Well, at the time, we actually did have a model that we used to get through. And it was, at the top layer of the model, it was very simple. There were three elements to the business that we had to design around, right? One was go-to-market, one was offering, and one was delivery. So go-to-market, again, had to be designed around the TAM segments you were going after. How do the customers buy? Who is the customer? What are the unit economics, which dictate, do you do this through partners? Do you do this through a face-to-face sales force? Do you do it through digital go-to-market? All of those things had to be dictated upon the go-to-market. So, your go-to-market would be constructed along those lines. The offering was essentially, in this case, there was lots of offerings, but if I dumb it down, it was one offering. It was third-party support services, right? And it went around a whole spectrum of hardware, software, network equipment, whatever it was, right? iPads, depots, right? Everything. Those offerings were composed off of the capabilities in that delivery platform and model. The delivery platform becomes in your description of the platform picture, it becomes a container for core capabilities, right? It's not necessarily linked to a single product / offering or a single business line, if you would. So when we took that and we kind of used that model to construct the business, we ended up with a dedicated go-to-market. We ended up with an offering structure that was split between, hardware support, software support, premium support, etc., bundled support, right? So basic value propositions to a larger customer base. And then that core delivery platform, we extended it. We extended it with things like AR and VR capabilities, right? if you're a technician going into a large data center and doing maintenance on a machine and you're wearing goggles, you can be guided by an expert in a center, right? Um, we introduced several blockchain capabilities around massive amounts of invoicing for individual parts and equipment, right? All of these kind of innovation type of capabilities we would apply. We had a whole framework around how to think of strategy and how to think of capability. And one of the elements of the framework is, what is your innovation stream? What is your innovation content? So those types of things would live in that bottom. So so if you think about that 3-layer model, and where do certain things surface? Formal organization, more in the go-to-market, right? Innovation streams in that delivery box. And that I will caveat, like that model I described to you, that is tuned for a services business, and tuned for a services business with maybe a set of core assets that under which all I think all valuable services businesses have that. It could be IP, it could be frameworks, it could be capability, it could be software assets, could be platforms, etc.
So fascinating. I think just really helpful to kind of get in your head and think about and just sort of get a peer to how you conceptualize things. Just going back to the story. So how does the story end?
The finish line per se was $2 billion. And how do you cross that line? We estimated it would take 5 years to get there. We got there in just shy of 3. And it was a combination of a very effective go-to-market, in my mind, and, a value proposition, which I think hunted better than we ever thought it would. The value proposition for the IT manufacturers was excellent. And I think it was largely excellent because the cost to reproduce this capability was extremely high. I think the business, I've moved on from that business. So because it sat within another business, it's very hard to get visibility into what's going on. But that business is still running strong from everything I know and hear from my former colleagues. I don't know the numbers behind the business, obviously, since it's been some time since I've removed, but it's still going.
Just talk to me a little bit about the value proposition. I get it. I mean, the economic value proposition, like the cost for me to do this is so much higher than for you to do it. Just when you think of value proposition, what does the value proposition mean to you? And when with other businesses that you've built, how do you think of value proposition?
Yeah, look, I think value propositions have to have a clear alignment to an outcome that the customer gets, right? And I think if you look in the case that we were talking about here in this business, the customer certainly gets, the customer gets a service which does a few things, right? It's provided at a price which they probably couldn't do themselves for the same cost, right? So there's that set of economics. And then there is, how would they do this without the service? Well, I think they would do this either on their own, which would be very expensive, or through a combination of third-party service providers. And, the ability to kind of consolidate it all into one place was also another piece of the value proposition. You don't have to manage multiple vendors and multiple geographies and multiple jurisdictions. Yeah, one of the key things in the case we were discussing was it is global business. It was a global supply chain. It was attached to a business with reach in over 150 countries, right?
Amazing. Yeah. So I guess you're kind of like where I'm kind of like mapping that to is thinking about there's the value, when you're pricing, there's the value to the customer, and then there's the competitive pricing. And in this case, the competitive pricing was do it myself or manage multiple vendors. And so you're able to undercut both of those on the effort of coordination and the financial.
Yeah. And I think it's also, the known quantity of the quality of the delivery itself, right? And you put those things together, and that's the reason a customer will pick a supplier.
Right. Yeah. Yeah. You have the IBM reputation commitment as well. That creates another advantage. So, I'd love to. We're reaching the top of our time with you. So many other areas to explore. I'm going to summarize kind of where I am, and I wanted to know if there's something that we're missing. The goal here is to capture for business builders, whether they are intrapreneurs or entrepreneurs, what the key strategic concepts are that will help them make smarter decisions, avoid avoidable mistakes. We talk about looking where the profit pools are, the awareness of what horizon you're in the business and knowing that you can't stick to that. I did hear also these advantages of existing customer base, which maybe reduce customer acquisition costs, the pricing advantage of having the existing sunk costs, the reputation of IBM, then understanding what the systems and processes are that need to be aligned. And you have this go-to-market layer, the offering layer, the delivery layer. So you're kind of doing that alignment. You had a very clear goal of $2 billion, and you were clear on the value proposition relative to the competitive offerings. You thought about what the alternatives were for a customer. Those are like the key things that I drew out of our conversation. Is there anything that you want to add?
No, look, for the example we discussed, I think that's a great summary of the major themes. I think when you look across other businesses, obviously there's going to be other things. I think in the differentiation area, your differentiation can come from multiple places. We had a business where, we wanted differentiation, and we acquired a company that was in the Magic Quadrant of Gartner to get that differentiation. There was another case with security services business where the differentiation we had really was our ability to quickly train engineers. And we were able to build a services business out of that. So I think there's, while this was the kind of example we latched onto, I think understanding what your core differentiation is, which then will drive your business model design, it'll drive your margin, it'll drive your capability to have pricing power, right? It'll drive what type of value proposition you can offer to your customer. I think it's really the key part of it. And even in the example we talked about, that's where we started, right? We were troubleshooting a business, and we were trying to understand, what are the key differentiators in this business, right?
And I think that kind of also what I'm walking away from is that there are so many differentiators. It's not, I don't think maybe what I was kind of like thinking of before this conversation of coming up with were like the 5 key differentiators. You have capabilities, you have cost, you have, I don't know, something, but they're probably like so many. You just got to approach it more like an artist than an engineer and think creatively about what those differentiators could be.
Yeah, especially if you're seeking scale. It's one of those things that you can't let 1,000 flowers bloom. You do have to focus on what is the differentiator that you think will help you with scale. And that, like you said, is an art.
Great. So not let 1,000 flowers bloom means not pursue a big bundle of differentiators, but really be honest about what your differentiators really are and focus on delivering on those.
That's right.
Tushar, this was great to just kind of peek into your head a bit. And I know if we had spent more time talking about other cases, we would add more to this. But I think we got a really nice framework here. I've identified several of the key tools or concepts or ways of thinking that we can arm other business builders with. So I just want to thank you for taking the time to unpack this for us. Thanks for listening to this episode of Strategy at Scale. Thank you to our guest, Tushar Amin, our producer, Oscar Perez, and our teams at Scaling Up Outthinker and Growth Institute. If you like what you heard, please follow, download, and subscribe. I'm Chaim Krippendorf. We'll catch you soon with another episode of Strategy at Scale.